Hello, bonjour, and miigwech. Welcome to what I will call Wading Through Economic Filth or Wealth of Nation. I haven't figured out the working title yet. I'm going to seek to explain things going on in the Canadian and global economies. I'm Greg Quinn. I've spent the last 2 decades as a business reporter in Ottawa. I have a master's degree in economics and another in journalism. I'm trying to merge those skills into this evolving world of media technology at a time of rising disinformation. I also hope to be a little bit entertaining for the economics world. I wrote a book, which you could see over my shoulder, about the work of Canada's central bank over the last few decades. Inflation and affordability have dominated politics and society recently. The Bank of Canada is a big part of the picture when it comes to those topics. Which brings me to 2026. Later this year, the bank will set a new agreement with the federal government on how it will seek to control inflation over the next 5 years. Now's your chance to think about how this will affect you. But before we get into this year, just a slight detour into history. The Bank of Canada was the first G7 country to adopt a numerical inflation target, behind only New Zealand. This was done in the bad times of the early 1990s. That was when foreign investors were hesitant to fund our large deficits. The economy was in a deep recession, and the government was afraid that its new 7% GST, the federal sales tax, would not just weaken sentiment further, but it would risk boosting inflation. So the Bank of Canada brought in inflation targets. They worked, and they worked fast. Not long after that, the target was brought down from kind of a fuzzy zone to somewhere around 2%. There was some debate about setting it even lower, but if you think about a world where we all like to see our paychecks rise each year, putting inflation around zero might imply that in most years your salary would not rise. Or even imagine a year where your employer came and said, prices are so low this year, we're going to cut your paycheck. That's not a very popular sentiment. So that history brought in, let's come back to this year. After 3 decades of targeting inflation at 2%, the bank has finally decided to stick with that as a guidepost. That frees up time to focus on other issues related to inflation. Now, first, I'd have to say, after the recent bout of high inflation, its credibility may have suffered. And so that brought a debate about whether, perhaps you should accept that inflation is going to be higher and raise a target, or some people maybe might have thought if you lower the target, it will restore the bank's credibility. I would suggest, and this is maybe what the bank has come to, is that changing the target after a period where you weren't making it is not the best recipe for true credibility. More importantly, you can look back, and most experts agree that the system worked as well as it could have in difficult circumstances. Inflation did go up to 8%, but after jacking up interest rates, inflation did come back to 2% in fairly short order. Canada also achieved a rare so-called soft landing. That is, even after a period of high interest rates and high inflation, we returned to somewhat normal conditions without experiencing a recession. We also managed to do that without a wave of highly indebted homeowners defaulting on their mortgages, which is another great thing that is not directly related to the Bank of Canada, but overall macroeconomic stability helped. I believe there are some who would still say the bank should be blamed for high inflation after the COVID lockdowns ended. What you can say at the least is that with a 2% target, a clear goal, the bank at some point had to be on notice that they weren't meeting their goals. In past eras, like the 1970s, it took much longer to realize the problem, and it was much more difficult to bring down. I would also go back to the experience I referenced earlier. When inflation targets were brought in the 1990s, it was a time when everyone thought inflation was about to get out of control. But once the public and investors realized that Canada had made a clear commitment, and that also included some very painful fiscal cutbacks, the target succeeded faster than most people could have hoped for. Again, with the acceptance that 2% seems to be the right target, officials have said they will focus on whether there are other changes needed to deal with a global economy that has become more prone to inflation bumps. Think of the rise in commodity prices after Russia invaded Ukraine. Think about the rise of tariffs brought on by the United States, and think about the loss of global cooperation and free trade more generally. All of the advantages and cost reductions from cooperation seem to be in question now. And even if we get more resilient and secure supply chains, that does come at some cost in terms of prices. Another long-term idea here economists have thought about is we really seem to benefit from a long era where prices were pushed down by factors like the rise of global free trade, a more global workforce as China and Eastern Europe were integrated into the global economy. And so now it seems like there may be an era where inflation is more likely to be faster rather than slower. I would also argue, though, that during the so-called low-for-long era of inflation and interest rates, some officials probably regret that even when inflation was a little bit below 2%, they pushed quite hard to get it up to the official target. And that often created accusations that they were feeding asset bubbles, and there were other side effects. Also, look at the property market we have now in Canada and how expensive housing has gotten in other places around the world. If there is a so-called natural rate of inflation or a long-term tendency for inflation in Canada and the world, it may be a little bit dangerous to seek to push things down to precisely 2%. Now, to be fair, the Bank of Canada system is what's called flexible. There's not exactly a rigid timeline for the Bank of Canada to get inflation back in line. They also don't have to go back and fix past misses. So in some ways, we have some insulation against that kind of a danger. Another issue, there's a lot of attention being paid now to the true trend of inflation after measures of what economists call core inflation have misfired in recent years, even ones designed by the Bank of Canada itself. This is a subject for a future video, but the idea that's emerging is it's quite hard to find one so-called core measure that can see through all kinds of short-term wiggles and price gains. Ideally, what a central bank would like to have at its disposal is a core measure that answers this question. If there's a short-term spike in a certain group of prices, that may lift the total inflation rate. But that could be a specific short-run pressure in a certain industry or a certain group of industries. It could fade away quite quickly. And because monetary policy works very slowly through the economy, it takes a year or two to get through, the last thing you want to see is your central banker playing whack-a-mole, trying to hit down forces of inflation that are going to disappear on their own. So while it would be nice to have a single core inflation measure that's clear and works, we've seen a lot of difficulty over time with big swings in, say, energy prices, auto insurance rates. There's been talk lately about the cost of services and housing itself. It's very difficult to cover changes across all those different industries and also over all the different economic cycles we've had in past decades. So, another topic, of course, I've mentioned this a few times already, is housing. The bank has said it's going to look at the interaction of housing and monetary policy. Most younger Canadians may feel that this ship has already sailed, given the low affordability and the supply squeeze in many markets. Again, you might ask for future reference whether this era of very low interest rates we had for a very long time helped fuel Canada's housing boom, and if there's any lesson for the future. Experts are also wondering about the language that was included in the last review about seeking maximum employment, but only when the inflation goal is firmly in hand. Many economists saw this extra language as a watering down of the inflation mandate, and at some point it creates a little bit of danger around inflation and inflation expectations. The bank has not really laid out clear circumstances under which it will or won't seek higher employment. And to be fair, most of the 5 years that this language has been around has also come alongside, as we've mentioned, high inflation. So the conditions just haven't been there to test to see, can you set looser monetary policy and experiment with how hot the job market can get. To be clear, there is a very significant example of a central bank that does have a dual mandate to seek both stable prices and maximum employment. That is the U.S. Federal Reserve, and those powers are granted by Congress, just as the Bank of Canada's powers are given in cooperation with the government and Parliament. All I can say is most economists believe that there are very difficult trade-offs between inflation and unemployment. And Many believe that if you take your eye off of inflation, you end up destabilize inflation and whatever else you're chasing after. It's also clear that the U.S. is the world's largest economy. The U.S. dollar is the most common currency in use, and that comes with certain privileges and certain heft. The U.S. probably has a lot more latitude than Canada to attempt a dual mandate. Putting all of this together, recent history shows the importance of having a robust and predictable monetary policy system. While there has been success at pulling inflation back from a global surge in Canada, there's also discontent around how long it took, the weaknesses we saw in measuring core inflation, and in some of the frothy markets we've seen in recently and over a longer period, whether it's housing or stock markets or other asset market weaknesses. The Bank of Canada has done what many economists see as a very good job on the whole, and that's in part because it had such a long history of using its standard toolkit, but also because during the COVID slump, it was able to deploy tools that it had been thinking about for years, the use of its balance sheet to give further oomph to the economy during the COVID lockdowns. The use of the balance sheet is still controversial to some, and that is another topic for another video, but it's fair to say the bank had that extra tool ready, and certainly in COVID, we needed some oomph in the economy. So a final thought about this. Again, inflation targeting has been in place for 3 decades now. The bank has stopped debating whether to adjust the 2% target itself. But the Bank of Canada was founded in another crisis during the Great Depression. It was founded in 1934, meaning it's coming up to 100 years of business. I would remind people that the original preamble of the federal legislation is quite broad. It goes far beyond a single inflation measure. Here's what the preamble of the Bank of Canada Act says. Quote, "It is desirable to establish a central bank in Canada to regulate credit and currency in the best interests of the economic life of the nation." I could stop there, but to give the full context, here's the rest of it. To control and protect the external value of the national monetary unit and to mitigate by its influence fluctuations in the general level of production, trade, prices, and employment, so far as may be possible within the scope of monetary action, and generally to promote the economic and financial welfare of Canada. That is obviously a grab bag of almost everything you could hope for in economic life. It's clear lawmakers saw a very broad role for the central bank. They do limit it as saying so far as may be possible within the scope of monetary action. Many economists argue that since the main tool for controlling the economy available to the central bank is an overnight interest rate, if you only have one tool, you probably can only influence one problem. And it is true that when it comes to inflation, interest rates are kind of a clear mapping. If you drew the mathematical equation with all the Greek letters on a blackboard of where inflation comes from, interest rates can play a significant role in that. Whereas if you look at the job market, interest rates may play a role, and they do play some role, but there are also other factors that are far outside the scope of monetary policy, whether it's social attitudes towards women in the workforce, whether it's immigration policy, education policy, global competition. None of these things are remotely within the scope of what monetary policy can accomplish. So the argument is monetary policy has to stay in its lane, so to speak. If you attempt to tackle some other goal, again, you take your eye off inflation, and then that gets out of control. But what I would say is the Bank of Canada constantly tells us that they have inflation under control. That is what their job is. In an era of disinformation and arguably low public education about the economy, should Canadians expect more from the legion of PhD economists at the central bank that they're paying for? Could the Bank of Canada example build on the success of its speech by its senior deputy, Carolyn Rogers, about breaking the glass to combat our historically weak productivity? You can make accusations that the Bank of Canada will lurch into politics. Yes, something like talking about the economics of climate change gets into a fuzzy political zone. On the other hand, watch any parliamentary hearing with the Bank of Canada governor, and it's the MPs and senators themselves who are constantly seeking the bank's views on their partisan talking points. So we are, in some ways, already in that world. So you could think about whether it would be beneficial to the Canadian public to have the Bank of Canada talking about more of this economic and financial welfare of Canada that was put in law almost a century ago. So, to go back to this narrow inflation targeting agreement that is due for renewal late this year, are there ways of controlling inflation better that could get agreement from the Bank of Canada and the government? These are questions we will see the answers to later this year. The impacts on the cost of living will be felt for quite a while. Before I close, rather than to tell you to read my book, I want to recommend a book I found useful. Here is The Worldly Philosophers by Robert Heilbroner. It's written for a general audience and is a good overview of some of the biggest philosophies that shape modern economics. So my next few videos will touch on some of the other ideas from my own book. That will include the future of central banking more generally and central bank independence, which you may have seen in the news lately. Hope to see you around. Thank you very much.